In this episode, we are going to talk about the federal gift and estate tax and how various exemptions, exclusions, and deductions may affect the gift and estate tax. In previous episodes, we talked about Pennsylvania inheritance tax, and each state has its own taxing authority. But in this episode, we are going to stick pretty much exclusively with the federal tax. So this is a tax that may apply to every U.S. taxpayer, although as we'll find out, not every taxpayer and very few will ever pay the federal gift and estate tax. Even if you never pay federal gift or estate tax, in this episode, we're going to cover some concepts surrounding gifting, which can apply much more broadly to a state's inheritance or estate tax. So stay tuned. And also, if this tax does apply to you or to a loved one, it's something that you definitely want to know about because the tax rate is significant at 40%. Let's start with the basic concept of gift and estate tax. So these are two separate types of tax, gift and estate, but they are intertwined. So we'll start with the presumption that any asset that is either gifted during a taxpayer's lifetime or any asset transferred by reason of death are potentially subject to federal gift and estate tax. Then we take a look at the exemptions, the deductions, and exceptions that would apply before a taxpayer would actually ever pay any of the tax. First, we'll talk about the exemptions. Even though federal gift and estate tax are two separate types of tax, they're under a unified system of taxation, which means the same tax rate structure applies to both, and there is a unified credit exemption. The unified credit exemption, it's often called the exemption or the exemption amount, is an accumulative amount of money or assets that are transferred during one's lifetime or at death that pass completely free from tax. In 2023, the unified credit exemption amount is $12.92 million for a single person. But what's even greater than that is the benefit of a married couple to use a deceased spouse's unused exemption amount, which effectively doubles the exemption for married couples to almost $26 million. In other words, if during your lifetime or at death, you transfer assets totaling less than $12.92 million for a single person or $26 million for a married couple, you will not pay any federal gift and estate tax. Now, those are figures that are established for 2023. This figure is not guaranteed to stay this high. That's the rate for 2023, but there is current legislation that is part of the Tax Cuts and Jobs Act that will cause that figure to revert back to $5 million adjusted for inflation in January of 2026. So what that will probably look like if it goes into effect is somewhere between $6 and $7 million. I've talked to a lot of people who I consider experts in this area of law, and there's really not a consensus on what's going to happen. There's a possibility that the government will allow the exemption amount to continue as it is now. There's a possibility that they will allow those sunset provisions to take effect, which will cause the reduction in the exemption amount. And maybe there's some middle ground. So it really is a political issue. It's a hot topic in estate planning, and I will absolutely keep you current as more information becomes available and as we approach that sunset date, which again is January of 2026. In addition to the unified credit exemption, there are also exceptions and deductions that may apply that can relieve a taxpayer from any tax liability. So first, we're going to take a look at two different deductions that apply to transfers during life and transfers at death. The first is the charitable deduction. There is an unlimited deduction for transfers to qualifying religious, charitable, educational, and government entities. And this is an opportunity for us to discuss a practical gifting tool. When you are making a gift to a charitable organization, especially if it's a substantial gift, you may want to consider what assets you are gifting. It can be preferential from a tax perspective to gift highly appreciated assets. And the reason is if you're making a gift of an asset that if you sold it would be subject to capital gains tax, when that gift goes to a charitable organization, if they sell the assets, they will not pay capital gains tax. Charitable organizations, if they are exempt, do not pay income tax, and they are exempt from paying any capital gains tax on the sale of an asset. So there is an exception to that for unrelated business income, but that's a topic for another episode. Next is the marital deduction. Marital deduction exists for any transfers to a spouse. There is an unlimited deduction for those types of transfers. Now we're going to switch gears and talk about three different exclusions. The first one that we will talk about is the annual exclusion amount, which is probably the most well-known, although I think there's a common misconception about how it actually applies. So in 2023, there is an exclusion of $17,000 for any transfer made within a taxable year. So what that means is that any transfer of $17,000 or less will not be subject to federal gift and estate tax. But the misconception is that if you gift over $17,000 that you're going to have to pay tax. That's not true, because remember, there is currently a $12.92 million exemption for gift and estate tax. So if you're gifting during your lifetime or transfers at death less than that $12.92 million, you're never going to pay tax on any of those transfers. So the way that this works in practice is if you gift more than $17,000 in a year, you're supposed to file a gift tax return to report that gift, which will effectively reduce your unified credit exemption by the amount in excess of $17,000 that was gifted. So the way this annual exclusion applies, I can gift to any person up to $17,000 in a tax year and do not have to report on a gift tax return and do not have to use any of my unified credit exemption. And my wife and I could each give $17,000 to any person, totaling $34,000 between the two of us. And on top of that, if we were making a gift to another married couple, we could effectively gift up to $68,000. So you have the $17,000 from me to spouse A, $17,000 from me to spouse B. That's $34,000 total gifted from me, and my wife gifting to spouse A her $17,000 and gifting to spouse B another $17,000. Those $34,000 to each individual combined for a gifting amount of $68,000. So you can start to see how the annual exclusion is probably one of the best ways to get assets out of your estate completely free from tax. The final two exemptions that we will discuss are the medical exemption and the educational exemption. And they both are very similar in the way that they must be applied, and they need to be applied in a way that's very careful. So for example, with the medical exemption, the rule is that I can gift or make a transfer to someone else to pay for their medical expenses. And that transfer is not subject to tax. But if I'm going to do this, I need to make sure that I'm making the payment directly to the medical provider. I can't make a transfer to the individual and then have them pay their healthcare expenses. You probably will run into a problem if you try to do that, so it's really important to make sure that the payments are being made directly to the provider. The same concept applies to educational expenses. I can pay on behalf of another person their educational expenses, tuition, but I need to be careful not to gift the money to the person, transfer the money to the person, and then have them pay for the educational expenses. I need to pay those educational expenses directly to the educational institution. Before we conclude, I want to give a practical tip, and this is something that I'll probably create a separate video on, but it's a concept that is really important while we're talking about gifting. If I make a gift, I am passing to the recipient of that gift my cost basis. So if I purchase Apple stock for $10 a share and I transfer it to my child when it's worth $100 a share, my child will take my tax basis of $10. So if they sell that stock, they're going to pay capital gains tax on the appreciation of value as if they purchased the stock at $10 a share. So what this means is that when you're gifting, if you're gifting to individuals, it's really important to look at what assets you're gifting. Cash is always preferable, or a cash equivalent, or an asset that hasn't highly appreciated, unless you want the person that you're gifting to take your built-in or baked-in tax liability. You want to make sure that you're not gifting highly appreciated assets. So this is a nice little tool that, as you consider making any gifts during your lifetime, you want to consider what gifts are best to give. And finally, what I'll just hit on very quickly is that if you pass away owning highly appreciated assets, your beneficiaries of those assets will have the benefit of a stepped up in tax basis. So any asset that passes by reason of death receives a step up in tax basis, so that the cost basis of that asset becomes its date of death value. I hope that this information was helpful or interesting or useful to you in some way. If you like this content, please let me know, and I'll look forward to seeing you in the next episode.